This is Nightly Business Report with Bill Griffith and Sue Herrera.
Bank CEOs go to Washington. The heads of the country's largest banks appear before Congress for the first time since the financial crisis. Year of patience. The Fed sees little need to change interest rates in 2019, but the door is open to hikes if needed. Pension pain. Some public plans are so underfunded that not even the decade-long bull market has provided a fix. Those stories and much more tonight on Nightly Business Report for this Wednesday, April the 10th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. You know, it's not often that the CEOs of the country's biggest banks are called before Congress. The last time it happened was during the financial crisis roughly 10 years ago. But it happened again today. The chief executives were back together on Capitol Hill testifying in front of the House Financial Services Committee. As a group, they defended a financial system that they say is more resilient today than it was a decade ago. Some of the questions they faced were focused on the industry's new challenges like cybersecurity and slowing global growth. Other questions were politically charged.
What do you think the biggest risk to our financial system is today?
Our ability to talk ourselves into the next recession.
I think probably the cyber we already mentioned, that is the biggest. I think the growing non-bank segment, I don't think it's systemic yet, but I think it's growing very rapidly. It should be closely monitored.
Global growth is slowing. U.S. growth is slowing a little bit. Global growth is slowing, and ultimately that will have impact on ability to service credit around the world, and that impacts the financial system.
Cyber, certainly first. I'd also say slowing growth around the world, but in particular, the difficulties that lie ahead in the relationship between the U.S. and China.
I'm just asking that if it seems fair to you, the ratio of the amount of money that you are making compared to the 49,000 average employee is making.
My compensation is decided by our board and voted on by our shareholders.
Just unbelievable. How can we make America competitive when there is a large number of young people that are graduating and they see no future?
This group pays all their employees quite well, including medical, retirement, minimum wages, usually at $18, $37,000 a year, something like that. Competitive business will drive wages and jobs over time.
Would you say, Mr. Diamond, that we're a leader in global finance?
I think that America is a leader in global finance, and I hope to God that we remain that for the foreseeable future.
So is the U.S. banking system better and safer than it was 10 years ago? Joining us tonight is David Ellison. He's portfolio manager of the Hennessy Large Cap Financial Fund. David, good to see you. Thanks for joining us tonight.
Hello, Bill. It's good to see you. It's been a while.
It has been a while. Certainly they are better capitalized than they were 10 years ago, but do you think they would be able to weather another financial downturn should there be one?
Well, I think, some of what we heard today was kind of rearview mirror. I think clearly they're ready to handle a credit cycle. They're ready to handle a liquidity cycle and to some degree even a rise in rate cycle. I think that one thing that they didn't mention today at all was the real damaging impact that lower rates has done to their business and what rates, if they go lower, what it would do to their business. So I'm surprised they're fighting the old war of credit and liquidity and capital is over. If we end up like Japan, their margins are going to get hurt pretty badly. And that, to me, is the biggest risk. If rates go down too much, lending will dry up, and that will be the problem.
You know, Jamie Dimon mentioned the so-called non-bank industry where a lot of highly leveraged loans are being made these days, and they're not regulated. How troublesome is that in your eyes for this industry?
Well, we had that last time, and that wasn't the problem. It was Bear Stearns and Lehman and everybody else. So all these shadow banks didn't create the problem. I don't think it's a problem today. Yes, they're big and they're levered, but that's not the issue. The issue, I think, and I'll come back to it, is what are rates going to do the next 5 or 10 years? Okay. We need them to stay here or go higher. They can't go much lower.
Another issue they brought up a lot, cybersecurity. How big of a challenge is that, or a threat to our financial system?
Well, it certainly is, and I don't know enough about it. And the disconcerting thing is that we have very few people in the country or in the world that know enough about it. So we have to hope that they are on top of it. Yes, they're talking about spending a lot of money, but I don't know how effective it is. But so far, so good. They're paying attention to it, which is the most important thing.
Before you go, favorite bank right now, or is there just one?
Well, I think the big banks are in the best position to spend the money to stay competitive and to continue to, in a sense, invest in their future. The smaller banks, they're stuck. They're being competed out of business.
Right.
Low rates are much more damaging to them. So I think to be conservative, you stay with the big banks, clip the dividend, and hope that they can, change their businesses for the better as we go forward.
David Ellison with the Hennessy Large Cap Financial Fund. Again, thanks for joining us tonight, David.
Yep, you're welcome.
And on Wall Street, stocks finished slightly higher as investors weighed new economic data showing moderate inflation and affirmation from the Federal Reserve that interest rates would likely remain unchanged this year. The Dow, when all was said and done, rose 6 points. That was it. The Nasdaq gained just about 55 points, and the S&P added 10. Steve Leisman takes a closer look now at the Fed and what policymakers were thinking at the central bank's last meeting.
Minutes from the Federal Reserve's March meeting say a majority on the Fed think the economy is likely to warrant no change in interest rates for the remainder of the year. And several members of the Fed think the current level of interest rates is close to what they call neutral, that is, where the Fed's benchmark rate doesn't stimulate or slow the economy. Because of several mostly global uncertainties, Fed officials warn in the minutes that their views on the right level of rates could change in either direction, that is, up or down. But one smaller group inside the Fed expects growth to rebound from the current bout of weakness. If they're right, they say that could warrant a rate hike later this year. There was no explicit comment in the minutes about any group or individual expecting rate cuts later this year. But there was broad agreement on the uncertainties faced by the U.S. economy. They include Brexit, the waning effects of fiscal stimulus from the tax cuts, and trade tensions. In fact, European Central Bank President Mario Draghi responded directly to President Trump's recent threats of new European tariffs, saying just the threats undermine the global economy.
Certainly, even the fact that these threats are being vented with some frequency is certainly undermine general confidence.
Europe is embarking on a new round of stimulus later this year, but for now, depending upon how the U.S. economy evolves and how these big global issues resolve themselves, the March minutes make clear the Fed is firmly on hold. For Nightly Business Report, I'm Steve Leisman in Washington.
And now to that inflation report, which posted its biggest increase in 14 months in March. The Consumer Price Index rose 0.4%. The gain was driven largely by the cost of food, gasoline, and by rent. But overall, inflation still does remain benign as domestic and global economic growth continues to slow. Elsewhere, Treasury Secretary Steve Mnuchin said today that the U.S. and China are making progress on trade. The two sides have now agreed on a deal enforcement mechanism, which had been a key sticking point.
We've pretty much agreed on an enforcement mechanism. We've agreed that both sides will establish enforcement offices that will deal with the ongoing matters. So this is something that both sides are taking very seriously.
Secretary Mnuchin also described the economic outlook as robust, and he said tariff issues should not get the blame for slowing global growth right now. With stocks up double digits so far this year and the S&P closing in on an all-time high, the thing that could derail the run right now is earnings. And don't look now, but here they come. Bob Pisani tells us what to look for.
Earnings season officially kicks off on Friday, and right now, first quarter earnings are expected to go negative, down 2.5% from last year. Now, this will be the first earnings decline we've seen since the second quarter of 2016. But the S&P 500 is still less than 2% from its historic high. Wait a minute, stocks are rising even with lower earnings forecasting? What's going on? Well, investors are focused on the future. That's what's happening. They're not focused on the past. Remember, the stock market is a discounting mechanism for a future stream of earnings. And right now, the bull narrative is winning out on Wall Street. What's that? Well, the bull narrative is that China and Europe are both bottoming, and that should lend some stability to the global markets. Now, the markets have gone from pricing in negative growth in the first half to rapidly re-accelerating growth in the fourth quarter and in the beginning of 2020. A lot of industries that were under pressure in the fourth quarter, so for example, think semiconductors, they've snapped back big time this year, all on this bottoming growth story. So KLA-Tencor, for example, and Samsung, a major chip supplier, said in January that demand would recover in the second half of the year, and essentially Wall Street has bought into that story, and that's why the market keeps going up. And by the way, flat or declining earnings don't necessarily mean that the stock market is in trouble. First of all, there's a very good chance earnings for the first quarter will in fact turn positive and won't be negative. Second, declining earnings do not necessarily correlate with a decline in the stock market. There have been many times in the past where earnings have been flat or declined, and even when the market declined, it quickly bounced back because there was no recession that followed. And that's the key. If you believe that there will be a recession in 2020, then earnings will certainly decline and go negative, along with the stock market. But it's not all clear that that's going to happen. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The Wall Street Journal reported this morning that even after one of the longest equity bull markets in U.S. history, many public pension funds around the country are still underfunded, some dangerously so. And because the stock market returns are projected to be below historic levels for the foreseeable future, the problem of underfunded public pensions is not expected to be solved anytime soon. Joining us tonight to explore this issue further is Chris Ailman, the Chief Investment Officer of the California State Teachers Retirement System, or CalSTRS. It is the largest public teachers pension fund in the country. Chris, always good to see you. Thanks for joining us tonight.
Good evening, Bill.
The problem is for the whole industry that the number of people who are retiring, the rate of retirements is growing faster than the returns that you can get on your investments right now, right? Among other things.
The baby boom is retiring. That's not a headline, but yes, they are. And so we're seeing an increasing amount, and it's expected. But this demographic wave needs to work through all the pension plans.
And every time we see a big decline in the market like we did after the financial crisis of 10 years ago, that's money out of your fund, and you have to play catch up over those years. And so, as the Journal pointed out, even this great bull market we've had for the last 10 years has not brought you back to full funding at this point because of that, right?
That's correct, Bill. But I want everybody to back up and think about the longer term picture. A pension plan, funding it is like climbing a hill, just like a 401k. You're climbing slowly over time. 2008 was a drop, a sudden valley in that climb. We're back to where we would be on that pattern of ascent, but we're still not at the summit. Right. Because it takes about 30 years to fully fund a pension.
And you're not fully funded. You're only about 70% or a little bit below that, right?
That's correct. We're basically right where we were in the late 1980s, early 1990s. And the one thing, as the article pointed out, that's happened to us in that time period, investments have generated the right return. But you know what? People are living longer. Right. And so longevity has been a challenge. We have to pay that pension out for a longer period.
I was reading today, how many teachers are now over the age of 100 around the country?
Well, in our plan alone in California, 364 teachers are over 100 years old and still receiving a pension.
They won the pension lottery in that case.
Yes, they did.
Is there a temptation, though, on your part or anybody who's managing these funds to take a little more risk than you would otherwise to try and play some catch-up as you try and reach full funding?
I think that's an active debate that retirement boards face on a regular basis, because there's only two ways to fund a retirement, whether it's a defined benefit plan or a 401k. That's contributions or investment return. So when you don't put enough contributions, you feel that pressure on that investment return. But the markets are only going to give you a very decent rate of return. You can't out-invest your way out of a problem. It really has to come from steady contributions. So I think boards feel that tension, but I have seen, in the case of our board in California, make very reasonable decisions to diversify and invest for the long term.
Do you agree, by the way, very quickly, that the returns for the foreseeable future in the equity market are going to be a little below historic levels?
Well, we're at a very late stage in a bull market. And historically, you would expect to see the market fade out. But as we've said, Bill, bull markets don't die of old age.
Right.
They can grow long in the tooth. As Bob Pisani was pointing out, there may be a recession out there in the future. So I think we're going to see choppy returns, slow growth. But I think, again, I look at 10 and 20-year time periods, and I think it is reasonable that we'll get a fairly decent return. Can't say where we'll go in the next 6 months or the next year.
Very good. Chris Ailman with CalSTRS. Always good to see you. Thanks for joining us tonight. Thank you. Time to take a look at some of today's upgrades and downgrades. Now, Apple was downgraded to reduce from hold at HSBC. The analyst cited concerns over its new services, including the potential for lower margins. Price target now $180, and today's shares closed at $200.62. Disney was upgraded to outperform from market perform at BMO Capital Markets. The analyst there cited Disney's streaming service launch and the opening of 2 new Star Wars attractions at Disneyland and at Disney World. Price target now $140. Disney finished up slightly at $117.16. Nordstrom was upgraded to overweight from sector weight at KeyBank. The analyst cited opportunities for growth in several areas of that retailer's business. Price target $55, and Nordstrom ended the session today at $44.94. And Under Armour was upgraded to buy from neutral at Citi. The analyst cited the company's renewed focus on profitability and a return on interest or invested capital. Price target $29. Under Armour closed up at $19.32. Coming up, if you're an investor in airlines or thinking about getting in, is the group ready for takeoff or a landing? Sanofi has cut the price of insulin for some of its patients to $99 per month. The drug maker made the announcement today only hours before one of its executives testified before a congressional committee on the rising price of the medicine. And during that hearing, she described the new pricing plan. As we've been reporting, the cost of insulin for treating type 1 diabetes has nearly doubled over the past 5 years. A Boeing shareholder has now filed a lawsuit against the company, accusing it of covering up safety problems with its 737 MAX jet. The shareholder claims that Boeing put profitability and growth ahead of airplane safety and honesty. And that's just one of the challenges Boeing faces right now. Several lawsuits have already been filed by victims' families who called Boeing negligent. And one of China's state-owned airlines is now looking for compensation from Boeing over the prolonged grounding of the MAX fleet worldwide. Boeing shares lost 1% on the day. Delta reported a solid quarter this morning. The airline posted better than expected profits and record revenue. The carrier plans to keep capacity consistent into the summer months, which will alleviate investor concerns that too many flights during peak travel season could lead to lower fares. And when asked about the impact of the grounding of 737 MAX jets by Boeing, CEO Ed Bastian said he has complete confidence in Boeing.
I'm confident Boeing will get to the right answer with respect to the fix, and we're all cheering for them, hoping that they get that product back in the sky as quickly as possible.
We should point out Delta does not have any 737 MAX jets in its fleet, and today that stock closed higher by more than 1.5%. So it's good to be Delta these days, but now that may not be the case for the rest of the airline industry, with some of its rivals lowering earnings projections right now for various reasons. Is now the time to consider airline stocks? Joining us tonight to talk about that, David Vernon is Senior Transportation Analyst at Bernstein. David, thanks for joining us tonight.
Thanks for having me on.
And I noted even with a decline for the group in the month of March, overall, the XAL, the New York Stock Exchange Airline Index, is up 13% this year. So it's had a pretty good year overall so far.
Yeah, I think coming into the year, there was a pretty large sell-off in the equity markets, and we started from a fairly low base. And I think what we've learned is a little bit more confidence in the booking environment and also in execution, particularly carriers like Delta and their strong earnings today.
But how much of an impact do you see the MAX jet grounding having on the industry at this point?
I look, near term, it's very disruptive, right? If you take these planes out, your pilots have been bid, your crews are ready to fly. It's very hard to take cost out very quickly. I think the airlines are now ratcheting down their schedules, and you'll see a little bit less capacity coming into the marketplace, somewhere in the low single-digit range of capacity coming out. And that will start to work its way into the fare environment. And as the airlines get better at scheduling down the staffing resources and the other costs that are required to run the operation, you'll see the financial turbulence settle down a little bit and earnings actually get a little bit stronger.
Delta seems to be doing so well these days. What are they doing that other airlines are not doing right now?
Well, I think one of the key things that they have going for them is their partnership with American Express and that rewards program. As far as an affinity group of flyers that a credit card company would want to target, travelers with a lot of business expenses, with a lot of expense going over the card, that's a very, very attractive market. Delta's renewed their partnership with Amex a couple years early. That's adding a point to unit revenue, and that's incredibly accretive for them in the near term. So one thing is that Delta arrangement. The other thing that Delta's doing really well is understanding how to monetize their network better. Go ahead.
Yeah, well, I'm sorry, I'm running out of time, but I want to ask you, late today, JetBlue announced they are going to begin transatlantic flights in 2021 from New York and Boston. Will that have an impact on that route? Will there be an airfare war? What do you think will happen?
I think at the margin, as Delta tries to carve out some share, you should see some weakness in walk-up fares. I think where there's a couple things where JetBlue is going to have some challenges. They don't have the same connectivity at either end of the network. They don't have a lot of the same capability that the other airlines have as far as a distribution channel inside of Europe. And as far as the configuration of that aircraft goes, we're going to have to see how they come out and how they're going to market that aircraft. It's going to be a little bit smaller than competing aircraft, right. And your price point, if you're going to are you going to be able to actually make that operation work? So JetBlue certainly has an opportunity to come into that market. They're not going to have as an attractive customer base as far as the corporate traveler goes. So we'll have to see how that plays out.
Indeed. David Vernon with Bernstein. Good. Thanks for joining us tonight. Elsewhere, Tesla and General Motors get a boost, and that's where we begin tonight's Market Focus with a bipartisan group of lawmakers planning to introduce a bill to expand federal tax credits for buyers of electric vehicles. As you may know, the existing $7,500 tax credit phases out over 15 months once an automaker sells 200,000 electric vehicles. This expansion would benefit Tesla and GM, both of which rose 1% in today's trade. Food processor Archer Daniels Midland said today it's going to open a voluntary retirement window for employees in North America. It may also cut jobs as part of a restructuring. The company said that the moves will strengthen the company's core business, and shares rose 1% today to $43.24. Bed Bath & Beyond reported better than expected earnings while revenue was in line with expectations. The retailer said that some growth came from its online sales. The board authorized a dividend increase and said that a governance review is ongoing. Stock was volatile in the after-hours trading tonight, finished the regular session up 5% to 1941. Coming up, what the White House is doing to try and lower energy prices. As it prepares to start selling shares to the public, Uber is aiming for a valuation of as much as $100 billion. According to the Wall Street Journal, the ride-hailing company plans to price its shares between $48 and $55 a share for its upcoming IPO. That valuation, by the way, is below the $120 billion that the lead underwriters had been pitching last year. Amazon's cashless stores will soon start accepting cash. The retailer did not say when that's going to happen, only that it is planned. Critics of the automated Amazon Go stores said that they were discriminating against so-called unbanked consumers who don't have credit or debit cards and typically pay with cash. Some cities like Philadelphia are enacting legislation that would ban cashless stores. Oil inventory surged last week. The Energy Department reported an increase of 7 million barrels, making this the third consecutive week of stockpile builds. But there was also a big drawdown in gasoline. And the price of domestic crude rose by 1% to a 5-month high. And it all comes on the same day that President made a push to lower energy prices. Kayla Tausche has details.
The White House wants to bring down energy prices by building more pipelines and bringing natural gas to places like New England that currently have lower supply. To do that, President Trump is rolling out 2 executive orders to spur more construction and transportation of energy.
My action today will cut through destructive permitting delays and denials. You know about that? You know about delays? Where it takes you 20 years to get a permit? Those days are gone.
The executive orders themselves give the president and the federal government greater authority to greenlight new projects. One grants the president sole authority to approve cross-border pipelines like the Keystone XL from Canada. The second shifts control of permitting back to the federal government from the states. There's one project in particular that's serving as motivation, the 125-mile Constitution Pipeline, which would bring natural gas from Pennsylvania through New York to New England. But the state of New York is overriding a federal permit on water safety grounds, and a legal battle has ensued. States and governors are expected to challenge this White House order too, but senior administration officials say the end goal is lower prices for customers. For a Nightly Business Report, I'm Kayla Tausche in Washington.
And before we go, one final look at the day on Wall Street. Kind of a quiet day. The Dow was up just 6 points. NASDAQ gained 55. The S&P was up 10 as we get ready for the flood of earnings. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching. See you tomorrow.